Hello and welcome to Trading Price Patterns, another great webcast from Schwab Coaching. My name is Ben Watson. I'm not Barb Armstrong. I'm filling in for her today. You might have guessed that from the accent, but I'm joined out there in the chat by my good friend James Boyd, 20-plus year veteran of the financial markets and phenomenal educator in his own right. He's going to be there to help answer questions you guys might have, and he's already got a good active conversation going on out there in the chat as well. So welcome to all of you if you're joining us in the live version or in the recorded version as well. Thanks for being here, and we appreciate that. We're going to be talking about price patterns today. Some interesting stuff going on. We're going to take a look at a flag, maybe a rising wedge, and a couple of other things as we jump into this discussion today. And as we do that, we hope that we won't frost anybody's petunias. I know that that's something Barb likes to talk about, but let's jump into this discussion. Remember, everything we talk about is simply for illustrative and educational purposes only. It is not a recommendation of any particular pattern or strategy or security or account type. Remember that options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering trading any options strategy. Remember that spread trading must be done in a margin account. Multiple leg option strategies are going to entail multiple transaction fees. So be aware of all of that. Now, the primary premise of this discussion is technical analysis, but technical analysis is only one way to look at the market. You get things like fundamental analysis, probability analysis. All of them are theoretical in nature. None of them guarantee what the market is going to do. So in light of that, Schwab doesn't recommend the use of technical analysis as a sole means of investment research. Remember that we're going to be using the thinkorswim desktop software platform today, specifically the paperMoney side of that application. It is not a guarantee of future success out there in the real world, but it's a great sandbox in which we can learn and play. Also, remember that as we talk about any strategies in this discussion, remember that these are simulations, that things may be different in the paperMoney world than they are in the real world. And as we talk about putting these strategies together, there's the possibility one might put spread trades together. Remember that anytime you're short an American style option, there's the potential for that option to be assigned early. But if you're in the paperMoney version, it's not going to happen in paperMoney. So make sure that as you move your practice from paperMoney to live trading, that you're aware of some of those differences. And of course, when we talk about stops, remember that stops don't guarantee the execution price, just the activation price. In the event of a stop limit order, there's the potential that the price may gap around that order level and not get filled at all. Finally, past performance, no guarantee of future results. I should have put on a long black wig. Wow. Gosh, John, I don't know about how to answer that particular comment. All right, here's where we're headed today. We're going to take a look at what's going on in the market. We're going to take a look at some example ideas, and we're going to look at this process of evaluating and finding price patterns as we get into this discussion. Real quick, though, before we do that, a couple of quick announcements. We are going to be in Scottsdale, Arizona, the Phoenician, James Boyd's stomping ground. Of course, James Boyd likes to go across the street, the JW Marriott Camelback. But we're going to be at the Phoenician on March 7th and 8th in the warm sunshine, hopefully in Scottsdale. When it's cold up here in Utah, it's nice to go to Arizona. But we're going to be doing our technical analysis and option strategies workshop there. Then we're going to be going to what might be cold and snowy Chicago in March. Sometimes it gets that way for our advanced options workshop on the 21st and 22nd of March. And then Detroit, going northbound apparently, Detroit Marriott at the Renaissance, April 11th and 12th, talking about technical analysis and option strategies again. And if you want to join us, just click on schwab.com/events for the registration pages and the full schedule for all of our live events coming up. Now, as we do that, let's jump into this discussion here really quickly. I'm going to switch over to the thinkorswim desktop software platform. And as I do that, a quick reminder, I have one ask from you. Well, I might have a couple of others, but the one that I have right now is if you'll click on that subscribe button down at the bottom of the page, you'll see it down in the bottom right corner. Click on that subscribe button. That's going to connect you to the Trader Talks webcast page, and it's going to allow you to do things like set alerts and so forth, and it's at no cost to you. But let's take a look at what's going on in the market today and kind of set ourselves up and kind of set the table here. For those of you that were with me with our trading index options webcast just a little while ago, we kind of went through some of this, but we see that the market may be bouncing down from that resistance level, kind of finding a little bit of a support at the 50 period simple moving average along with this inclining level of support. So overall, it's kind of creating this ascending triangle look. Maybe, I don't know, maybe a bit of a symmetrical triangle, but a little bit of an ascending triangle scenario where we have kind of this general overall resistance level, in this case up around the 6095, 6100 level or so on the SPX, and then this inclining level of support going along with the RSI. And if you were with me earlier, we saw this RSI kind of breaking down below that diagonal trend line, the relative strength index, kind of a measure of momentum. In this particular case, rising RSI would indicate positive momentum or bullish oomph behind the price movement. A falling RSI is generally going to indicate that candles are closing closer to the lows and potentially indicating bearish momentum. We're not seeing really bearish momentum. It was kind of bleeding below, but it was roughly at an equal low. Now starting to see that pick up a little bit, despite the fact that we had a hot CPI number, consumer price index number today, that would suggest maybe that rates are rising still, number one. Number two, that inflation is still a little bit hotter. And number three, and probably most importantly from the market's perspective, that there's less of a chance potentially for rate cuts sooner. So we might be seeing higher for longer types of rate perspectives. And the market shook that off very quickly and has bounced up off of that level. At least the broad market has, the SPX has. The NASDAQ also doing that a little bit stronger move here. We're getting some rotation perhaps out of bonds into some of these technology leaders and a little bit of a strong bounce there. But the Russell 2000 finding a bit of a support level, but that was a much stronger gap down. Now a little bit of a rally, but the RSI is still kind of trending off. So it wouldn't be at all outside of the characteristic here from a technical analysis perspective to see this maybe bleeding off a little bit. It's already starting to come off of those highs just a little bit in the Russell 2000, which arguably is more interest rate sensitive than the other indexes. Now, speaking of sensitive to things, we've got a feedback survey out there in the chat. Now, I'm not saying we're sensitive to those things. We want to hear everything you have to say, and we want to hear your comments and what your expectations and what your ideas are. So if you wouldn't mind, just take a couple of minutes, click on that link, open up the feedback survey, set it aside, and then you can go back and you can finish it afterwards, or wait. And you run the risk of waiting that we might close the webcast down. You wouldn't get a chance to fill out that feedback survey, but we'd love to have you fill out that feedback survey. That helps us out in making these sessions better. All right, so let's kind of pop back out here a little bit. One other thing that I want to look at really quickly before we jump into specific strategies and specific ideas is what's going on with the volatility index with the VIX. And earlier today, we were seeing that VIX up just slightly above its average. This is a 30-period average on the VIX, which is kind of interesting because the VIX in and of itself is averaged over 30 days. So this is a 30-day average of a 30-day average index. But seeing that coming back off of or below that 30-period average, kind of getting squeezed here a little bit. And we start to see that squeeze happening here, a little bit of volatility bleeding off as the market rallies higher. So not a big spike in volatility, not a lot of buying on the protective side, because generally the VIX is going to get driven harder to the upside by put buying activities. And maybe not seeing that happening here in terms of the market moving back to the upside But remember, this is the SPX, and there are others there are other measures of volatility in the market that may be more relevant. One that's oftentimes kind of an interesting perspective is the VVIX, the volatility of VIX. Let me move these labels a little bit so that we can see them. So the blue line is the VIX. The white line here is the volatility of VIX. So volatility of VIX kind of falling off a little bit, suggesting that there's just not a lot of movement here. There's just not a lot of fear at the moment. And that lack of fear and lack of willingness to buy fear, in this case, buy options, would suggest that maybe there's never stability in the market. The market is too dynamic an environment to suggest that there's stability, but it might suggest that the prevailing trend, which we looked at there on the broad market, still intact, at least at this point, not breaking down. No guarantees that it won't. All right, let's take a look at some individual circumstances here. And in order to do that, I'm going to do two things. I'm going to pop over here to a grid that I have built called the single grid, and it's just kind of a sandbox that we can play in. There's the SPX. You can kind of see it without those trend lines and without the moving average kind of filtering things out. And you can see that kind of gap down rally that we're getting today. But in and of itself, it's kind of building a little bit of a price pattern that's going on here. We kind of see that little bit of a maybe symmetrical triangle look going on the SPX. And, as we start to see this type of pattern, this can oftentimes occur. And we saw one here, we saw one kind of previously, and then it broke out. You saw the same kind of pattern establishing itself. You saw an excursion to the downside, and then a move back to the upside. And now it's kind of consolidating again. So overall, there's some consolidation forces going on. You've got support and resistance levels converging on one another here. A bounce up off of that lower diagonal trend line. So squeeze, squeeze, squeeze. And some point, the market's going to do something, right? You think about, I don't know, I've been over to James Boyd's house. We've been to a couple of summer picnics. And one time I was over at James Boyd's house, and he was eating some watermelon. And he took a watermelon seed, and I don't know why he did this, but, he picked the seed out of the watermelon and he squeezed it between his thumb and his forefinger. I happened to be standing next to him, and I didn't think it was going to go in my direction, but he squeezed that watermelon seed and it hit me right in the eye. And sometimes that's what can happen with price when it gets squeezed in between levels of support and resistance. It can oftentimes pop pretty significantly in a direction. Oftentimes it will move in the direction that the trend was coming into the pattern. So we've got an uptrending SPX, and oftentimes that trend direction will persist coming out of that squeeze. But sometimes it goes the other direction and it'll hit you in the eye, right? So you got to be careful. You got to watch out for that, especially when you're standing next to JB at a summer picnic. It's kind of crazy. But that being said, there's that potential for upside movement. We see that then playing itself out in individual stocks. So I'm going to change my single grid here to an individual stock that I happen to be watching, and this is in a watch list. So we're not going to really talk about what stocks we're going to trade here, but how we might look at entries and exits. Now, when we talk about what stocks, we've got lots of great research, lots of great webcasts. In fact, James teaches a couple of them that talk about searching for stocks and the kind of characteristics you want to see in those stocks. This happened to be in one of my watch lists, TTWO. Remember, this is not a recommendation, simply an illustrative example. And in fact, I used to teach a webcast called Trading Flag Patterns, and this is one of the kind of vestiges and remnants of that particular webcast. I happen to have this in a particular watch list. And so what I noticed going on with this pattern, or with this particular stock off of the earnings announcement, is that we got this big gap up, right? So it gaps up and it blows up through this resistance level right around that 192 mark, right? And we get that rally up and that little bit of a pullback. And the possibility is now of a bit of a bounce. So we've talked about this idea before. I know Barb talks about this in terms of how do we know that price is bouncing. So there's a couple of things going on here. The one thing that I noticed is if we were to just look from a flag pattern, right? Because a flag pattern looks like this. I'll grab my magic marker. Flag pattern is going to look like this. Rally up, pull back, and then the assumption is that buying pressure takes over again and then it pushes price higher and that it's kind of duplicative of that distance that it traveled to get to that high, and then we get that breakout to the upside in the pullback. But here we have a situation where, boy, we've got this earnings announcement that popped it up off of this low, and so you have this big gap here, right? That gap. Not to be confused with gap earnings, which would be GAAP earnings. But this is a gap on the earnings announcement to the upside, and so it breaks above that resistance level. We see that continuation. Now, here's the thing. If we were to just simply say, fine, I'm just going to duplicate this distance. So let's say that's 10 points, that we might expect that this distance is going to be 10 points as well. If we were to just duplicate this move, that would assume that we're going to see another earnings move. Well, we're not going to see another earnings move for another 3 months in this stock. We're not going to see that type of input into this stock for that length of time. And you go back to the last one, and there was a gap there, but it wasn't nearly as big as this one. So we can't count on that, past performance not being indicative of future success or future performance. So what do we do? So here's the thing. Here's what we might think about. Let me delete those. And we'll talk about number of days and all of those things. So if I were to I might use this area in measuring this flagpole distance. I might use this resistance level, which is now potentially a support level. And so I might draw a line, and I might just go, say, for instance, from that support level, in this case, 192, we'll call it 192 for easy math, and we'll run it right back up to the top here. So that's about a 11-point move to the upside, or 11% move to the upside, about 23 points, if I were to take that. Now, if I come back over here and I right-click and I duplicate that, now I could come back over here and say, if this is our support level that gets created and we get a bounce there, where is the potential target for this pattern, right? And that would put that potential target out here around that 230 mark, right? We'll just make that kind of that dashed line so we know that that's that potential area of some resistance if we were looking at this as being a flag pattern. So here's the thing, flag pattern, to go back to Gazelle's question. Gazelle asks the question, how many days are these flag formations on an intermediate time frame, right? Which is generally what what swing traders may look at. Some swing traders, you typically see the flagpole develop over a couple of weeks to maybe a couple of months, and you see the pullback occur typically between 3 to 5 to maybe 7 days. Now, it doesn't always happen that way, but the pullback typically tends to be shorter than the creation of the flag. In this case, we have exactly the opposite. We have the flagpole being created in the matter of 1 or 2 days, and then a pullback that is now 2 days long. So I'm going to kind of attenuate or detune this flag a little bit just to maybe put it into some perspective, because that's a pretty big move to the upside. And again, it comes off of, and that's even taking it down from the absolute bottom, just from the support to the resistance. We might just now say, look, I'm just going to make this move measured from, and I'm just going to right click and we'll activate this, measured not from the support, but right from the bottom of the candle, right? And so if we do that, then let's delete this line and let's duplicate this one. And we'll say, all right, fine. If this is coming off the bottom there, where does that now put our attenuated target? Maybe up here around 226. And we'll right click, we'll activate the drawing, we'll kind of bring that resistance level back down here. So we're going to look for a potential target out around the 226. And that puts us kind of in this detuned or maybe more realistic expectation for this flag pattern, rather than relying on the idea of another repetition of an earnings driven bounce, right? So the other thing to think about is, where would we know that this flag is not a flag anymore, right? Where is it flag, not a flag? And so we might say, well, look, I'm going to zoom in, zoom in a little more closely here. And I'm going to kind of take that back to our auto range here. And I might say, all right, I'm going to take the midpoint of the body of this candle as kind of the area at which, if this breaks below the midpoint of the body of that candle, it really is coming back from a momentum standpoint that says it's going to take a lot to get back up to that target. So if it starts to fall below this level, that's going to kind of invalidate this as a potential flag. It doesn't mean that it won't. It doesn't mean that it can't. It just means that it's less likely if it pulls back more than about 50% of the flagpole. So we're even giving it a little bit more here, right? So we could even do this with Fibonacci's. Grab our Fibonacci here, and I know I'm going to be heretical here, and I'm going to draw my Fibonacci's, in this case, from the top of the flag down to the bottom of the flag, and I'm going to say, all right, if it really breaks more than kind of that 50% Fibonacci level, then it's likely not to accomplish our target as a flag, right? The other thing is, if we kind of zoom back out here, notice where our 161.8 Fibonacci target becomes. It becomes a little bit higher. So even this attenuated target is kind of right in that same area, right around the 226 to 228 level from that perspective. So I'm okay with that. I'm kind of okay with that, drawing that line there. So this would be however, the point at which I might say, if I were using the Fibonacci's, that this is not likely to accomplish the bounce. So we're going to put together a potential trade here on this bounce. So ideally, so we've got an uptrending candle, right? So we might say, well, okay, I know James Boyd told me about that whole hold thing, close above the high of the low day. And Barb talks about that whole hold thing. And Ben's mentioned it in various places and workshops and things. But what does that really mean, right? Close above the high of the low day. So here we are, kind of middle of the day, right? We're midpoint in the day. Is there a better way to maybe accomplish this, maybe a more rapid way to accomplish this? So we might say, what is it we're trying to gain by that close above the high of the low day? And by the way, I'm going to delete that Fibonacci just so that we have a little bit clearer picture here. We know where that target is. I'm going to remove that one. And so what I'm looking for here in this particular case, because, you know, we could say, all right, where's the most recent low day, right? Why didn't I extend the fibs? Because I'm just looking at this move right here, right? I don't want to take it all the way out here. I don't want to be over exuberant. I don't want to take it down to here because I don't want to be over exuberant, right? So I'm really kind of taking a conservative approach on this flag, because this move from here to here was driven by the earnings announcement. That's 100% the reason why I'm moving that. You can do it. You can certainly take that all the way down to that low, right? But you're not going to necessarily, in the context of this intermediate term flag pattern, replicate the oomph behind that earnings announcement, because you're not going to have another earnings announcement in that time frame. So that's why I'm taking it to that point. Okay. All right. So what I'm looking for is evidence that this is moving higher, right? Evidence that the bus is going north and not south. Because right now, the bus, if I got on the bus went up a little bit, it went north a little bit, it came down, it went south a little bit. Now it's kind of circling the parking lot, and I don't really know for sure. So I have to make a determination, at what point do I know that the bus is going north so that I can get on the bus? So for me, in this particular pattern, rather than waiting another day, because there's every possibility or every potential, no guarantees, that this could make a big move tomorrow, and I might miss that if I were waiting for that, or I might get into a point where maybe my entry point is a little bit less desirable. I simply want clear evidence the bus is moving north. that the price of the stock is going in a northbound direction. So I'm going to say, well, what would tell me that? And that might be a move above this 210 mark, right? So I'm going to draw a line in. Whoops, still got Fibonacci's on there. Come down, let's make that diagonal trend line. And I'm going to see, I want to see a move above, either a trade above or a close above that 210 level. That's the high currently for this day, right? No guarantee that that's where it's going to close or that it's going to stay within this range or anything else. But I want that evidence that this is moving beyond that range. And if you notice, if you could argue maybe that's a level of what was support now potentially acting as resistance, a break above that could be that entry signal. So what I'm going to look for then in putting this trade together, I know that my target is out here around the 226 mark, and my level of support may be down around here. So I kind of have this range in which I might look at this trade. So I'm going to get into the trade if it goes above here, get out of the trade if it goes below here, and get out of the trade if it goes to here. That's the potential for this bull flag type of trade. So what I'm going to do is I'm going to right click and I'm going to create a buy custom with OCO bracket. Okay. And we'll just build this together. I'm going to make this first one a buy stop order. And I'm going to say, fine, stop, wait, don't. Yeah, this is not the struggle bus. This is the northbound bus to wherever your northbound destination is. So I'm going to make the order to get into the trade a stop order. It says stop, wait, don't do anything until the price of the stock has gone above that 210 mark. And I'm just going to use 210 for easy math. You could give it a little bit of a threshold there too. But we're going to make that a stop. And I'm going to make that one actually good till cancel because it might not happen today, but it might happen tomorrow. And then I'm going to look at taking this off if it goes up to 226. We'll just call it 226 on the upside. 226. And recognizing that it might not get there in one day, I'm going to make that good till canceled as well. Okay. And now we're going to exit. Now there's a couple of places we could exit. We could exit below this level right here, right? We could exit below the low of today, or we could exit below here. And I'm going to give it a little bit more room to move to the downside because we might still get some downward dissension down into that support level. But if it goes below that level, yeah, that's the point at which a trader might be out of that trade simply because that represents kind of that 50% level, that halfway point in that big green candle, which oftentimes can act as a level of support. So if this breaks 203, I'm going to say if this breaks 203, we'll just call easy math here, right? And breaks 203 even. Now, we can debate the points at which you place stop losses. I know I've talked about the idea that maybe we don't want to place a stop loss at a big round number. So fine, I'll acquiesce to that. We'll go 202.97 is where we're going to trigger our stop to get out, and we'll make that good till canceled. And so now we've got our trade in place, right? Potential to move to 226 on the upside, potential to move to 202.97 on the downside and get triggered out, but no guarantees that we'll get out at 202.97. And then we got this as a buy stop at 210, and it's not quite there yet, but it's getting closer. So we might get in on a trade above that 210 level. It might happen tomorrow. Don't know, but we're putting the trade in as an if this, then that, right? If this, then that. All right, and we're going to go ahead and we're going to click on confirm and send. We're going to read through this order. Buy if it goes above 210, sell it if it goes to 226, or sell it if it goes to 202.97 and get out. We're going to read through those orders, making sure that we're aware of the characteristics and risks of stops. And we're going to go ahead and we're going to put this on, and I'm going to put this in our, let's go. I will just put this in our stocks group. There we go. We'll click on send and we'll fire that order off. And so that's going to sit there as a waiting order. And you can kind of see, and this is what's nice about having these orders pop up, and you can set this up by clicking on the gear icon and clicking on show orders right here. But this gives me kind of a nice perspective because I can visually see that if this is the potential for loss in the trade, that's less than this potential for gain in the trade if it goes all the way to the target. In fact, it's probably about this is probably just visually looking at about 2 to 1 reward to risk ratio if this trade comes together the way that that we've set it up. But there's no guarantee of that, and there is the potential that we could lose from 210 down to 203 or 202.97 is where we place that. So that's that bull flag trade, and that's just a simple way to go about looking at putting together a bull flag type of trade. The whole idea behind the bull flag is the bus is continuing north, i.e., the trend is up, but the bus might kind of pull back a little bit or slow down a little bit on occasion and then move higher and then continue to go north. But you don't want to be on the bus if it's going south. Right? That's the whole idea behind that bull flag type of perspective. So let's look at another one here. So this is one that I saw was, again, in my watch list, which is kind of interesting. So we'll just zoom back out, and I'm going to bring this in. This is J&J. So let me remove that one right there. So what I noticed is that we had kind of this inverted head and shoulders pattern down here. And even if we were going to kind of take this as an attenuated move, I might take that high to the low and then just duplicate this. Remember, patterns, markets like symmetry. So we do this little rally here up off of that breakout. And here's our, interestingly enough, there's our resistance level, maybe that target if we were looking at that pattern type target. And we've just had a little bit of a bounce off of there. So this isn't at all inconsistent with the idea of continuation of that bounce, continuation of that reversal pattern. We see the next level of resistance overhead is where it is right now. And what I want to do, though, this wasn't the pattern that I was really paying attention to at the moment. It wasn't that inverted head and shoulders. But I'm going to zoom in here, and what I noticed was going on, and again, I'm going to have my drawing tools on here. Even if I draw to the highs or to the wicks of the candles here, notice what's going on. I've got a little bit of this kind of, well, depending on where I draw it, we've got kind of this rising wedge almost going on. If I were to draw to the lows of the candles, most of them, I've got this rising wedge. Which, and yes, it is a giant kind of a overall, Robert, on a much longer basis, like theoretically a potential longer term head and shoulders. But here's what's going on, right? We've got this rising wedge, which suggests that, look, price is getting higher, price is going up, buyers are stepping in. So here's the thing, buyers are stepping in here, and buyers are stepping in here. And buyers stepped in here and pushed the price up. And sellers pushed down here. And the sellers pushed down here. And sellers pushed down here, right? So this almost becomes kind of a battle, a race to see which side exhausts their influence faster. So the challenge is sellers selling at a higher price. That's not such a bad thing for the seller because they're selling it for more, right? Buyers buying, though, at a higher and higher price. Buyers being willing to step in at a higher and higher price. That might be more exhaustive. That might be more exhaustive of buying pressure than those sellers selling at higher and higher prices, if that makes sense. So this rising wedge pattern oftentimes can be an exhaustion pattern. And it can be, especially when it occurs like this, right? As kind of a counter trend move to a longer term prevailing trend. So if our longer term prevailing trend is this, right? This intermediate to long term downtrend, we have this rising wedge as a counter to that trend direction. This oftentimes can be a bearish pattern, right? Can be a bearish pattern. So we might be potentially looking for this to kind of spill out the edge of that rising wedge. And you notice something that's happening too here, that if we were to extend these lines together, kind of out into, well, let's do this. I'm going to do this. I will actually extend these lines. So I'm going to delete my annotations, and I'm going to come over here, and we're going to right-click on extend to the right, and we'll right-click on this one, extend to the right. And here's our confluence, right? That's where they're coming together, okay? So the deeper this goes into this apex of this triangle, the more likely this is to be exhaustive in this particular case to those bulls, and the more likely we are to see this move in a counter trend pattern, right? Meaning a move to the downside. Yeah, George, you're exactly right. This becomes a kind of a giant bear flag. Also, you're right. We have a resistance level corresponding with that right up here. Love it when those lines come together like that. If we extend that one to the right, look at that. Boom, right on that apex. If we extend this one to the right, boom, right about where the candle yesterday went to. So here's kind of the likely scenario here from a price pattern technical analysis perspective. We're kind of in that zone here, 2/3 to about 3/4 of the length down that pattern, where running into that resistance level might yield this falling out the bottom of the pattern, right? And making a move maybe down to the next major level of support. That would be entirely the expectation of this rising wedge type of pattern, but it's not doing it yet. So what do we need to do? Well, we need to prepare for that possibility. If this, then that, right? So what do we do here in this particular case? We might look to draw a line right here that would be the indication of a break below that kind of lip of or edge of that rising wedge, right? So looking for a move to this side down below that level. So we're going to do this exactly the same way, right? That we did our bullish trend bull flag pattern. We're going to look for this fall out of the bottom of the rising wedge. So what I'm going to do is I'm going to right click, but here's our numbers, right? We're looking for this maybe move down to this next level of support. That's our potential target to the downside, right? And here's our failure point if it goes up. Now, the thing about this is if we were just going to trade the stocks, we would have to end up shorting this, right? But instead of shorting it, we could trade this in a downward direction by using an option. So we're going to trade this by using a put option, but we're going to do it by triggering based on the price of the underlying stock doing something, okay? So we're going to go back over here to the trade tab. We're going to look at Johnson & Johnson. We're going to say, look, this potentially, this has taken about almost a month to get to this point. I'm going to give it at least that much time and then maybe a little bit more. And I might go out to the 21 March expiration. Let's just double check our bid-ask spreads. They're fairly tight here. We might even look at that's the 21 March. Let's go look at the 28 March. Those are a bit, they're pretty close too. Maybe just a little bit wider, but that gives us a little more granularity in those option choices. And I'm going to look down here a little bit because I want to be looking at an in the money. That's a bit wider. So let's go to the 21 March once again. We're going to go to about the 70-cent delta, in this case, the 160 strike. And we're going to look at buying this to take advantage of that downward movement. However, we're going to trigger this order based on kind of that if this, then that. So what I'm going to do is I'm going to right click and we're going to create this buy custom with OCO bracket. We're buying a put option for the sake of, and again, remember, if you don't understand options, characteristics, and risks, make sure that you do before you consider any option strategy. So I want you to be aware of that and be clear on that. But we're going to look at taking this trade. We're going to look at getting into this trade if something happens, getting out of this trade if something happens, and getting out of this trade if something happens. So what I'm going to do is I don't know specifically what the price of these options are going to be. So I'm going to make all of these option price orders market orders. And you'll see why I'm doing this here in just a second. Okay? Because now what I'm going to do is I'm going to come over here to the right-hand side of my order line, and I'm going to make that a gear. I'm going to click on that gear, and I'm going to make these order rules function based on what I want to see happen. All right. So I'm going to make this one a good till canceled order. And I want to see price. Let me move this back here to our chart. I'm going to have to do it again. I'm going to cancel. And let's move this back to our chart. And let's bring our order back up here so that we can measure our lines here. So below 154 is our entry price. So click on the gear icon. And we're going to get into the trade. We'll make it good till canceled and trigger when Johnson & Johnson marks at or below. So I've got to do my little alligators to make sure I remember which is at or below, at or less, equal to or less than the price that we said was 154. All right, 154. James Boyd always makes fun of me because I have to do the alligators. All right, there we go, 154, at or below 154, okay? And now we're gonna click on save. That's our conditional order for that one. Now, to get out of this, we wanna get out if it goes all the way down to our target, which in this particular case, we said was right down here at this support level at 148. So we're gonna close this down with a market order if the price of this stock moves down to, we're going to buy it back, or I'm sorry, sell it back if this marks at or below 148. And we'll make that 148. And we'll make that one also good till canceled so we don't have to replicate it. Now, here's the thing. If we'll make that one good till canceled also so that we don't have to worry about that. We're going to put a conditional order on this last one, which is we're going to get out of this. We're going to sell it back if it goes above 156.78. We'll call it 156.78. So we'll click on the gear icon and we will go back here. We'll make that good till canceled. If this goes back to mark at or above 1, we said 156.78. Okay, 156.78 is now our exit price on the stock, triggering the order on the option. So here's what our order does: gets us into the trade if this goes down, if price goes down, gets us out of the trade if price goes up, gets us out of the trade if price goes down to our target. And we did that with a set of conditional orders in this OCO bracket order. We're going to click on confirm and send. And I like the way that this describes it now, because we have our order and then our conditions, order and then conditions, order and then conditions. So we're going to read through the order, make sure that that's what we want to have happen. We're going to go down and put this in our stocks group. And once we're comfortable with the order and that's what we want, we're going to go ahead and click on send, and we're going to put that order out there, and that order is going to be sitting there ready to go if the price of the stock moves to the downside to take advantage of that downward movement. So we've got an upward moving trade, we've got a downward moving trade, and you've got a feedback survey out there in the chat that James Boyd has reposted. Make sure that you take just a minute or two to fill out that feedback survey. But let me show you some additional resources if you want to learn more about these ideas. Come on over here to our Schwab coaching page. So go to schwab.com/coaching. You have the calendar of the live webcasts that we do. You have the calendar of the in-person events that we do. And if you come over here to our Trader Talks webcast page, let's go back to our home page here. If you wanted to search for flag patterns, click right there. And there you've got a bunch of webcasts that talk about flag patterns. All right. Now, you could do a conditional long put vertical. You could do a conditional short call vertical. You could do a number of different strategies as well. All right, but that's where you find some additional resources. Thanks, guys, so much for participating in the chat. Thanks for being here in this discussion. Here's what we talked about. We talked about some of those price patterns. We looked at some examples, and we put those price patterns on. We looked at what the market is doing. My thanks to James Boyd. My thanks to our great production staff for helping out. And of course, my thanks to all of you and for Barb giving me the opportunity to fill in for her today. It's about time for me to close this up, and we will see you all again very soon. Take care, everybody. Bye-bye.